Welcome to the latest episode of Beyond 60/40. I'm Sonali Basak, the Chief Investment Strategist at iCapital, and I'm joined today by Shirl Penney. He is the CEO and founder of Dynasty Financial Partners at a time of a lot of change for the wealth management industry. And Shirl, one of the biggest changes to me is how much M&A you're seeing. It has just been tremendous. But when you look at Dynasty's approach, you can see that a lot of your partners, they don't always need to sell per se. There's financing arrangements. There's all sorts of ways to help wealth managers, wealth advisors, RIA platforms grow. How do you think about M&A versus the rest of it all?
Well, first of all, great to spend time with you, Sonali. I appreciate it. The M&A space specific to Dynasty's clients is a little bit unique because Dynasty firms that we support, which is about 60 of them, own the majority of their RIA. So when they're out doing M&A, we may have an investment in them, but we top out at 20%. So when they're out doing investments or buying other RIAs, they're doing it from the standpoint of an advisor owner-led business, not necessarily a financial roll-up like you see out in the market. So for them, they're really focused on the right cultural fit, making sure that the advisor has the right type of client focus, client service construct. Are they growth oriented like they are as well? Are they going to be able to smoothly onboard them onto the platform? It's not just a financial transaction where there's a lot of roll-ups out there that are looking for multiple arbitrage. They're just looking to buy another business at a lower multiple than what ultimately they'll sell for. The firms that we support aren't really focused on that as much as they are building for the longer term and getting the right type of partners that are going to help them grow, not just inorganically, but organically as well.
Well, it's interesting because, you were saying as much as 20%, but what's happened recently is you've seen a lot of other types of investors wanting to experience the growth of the wealth channel, private equity firms, other types of investors. Bring us behind the curtain there. What are you seeing in terms of interest?
I would say that the RIA space, the wealth management space as a whole, is incredibly discovered at this point. Everyone knows about it. It's no longer a secret. And whether you're talking about sovereign funds or strategic investors, asset managers, financial investors like private equity, other well-funded standalone RIAs. So we, at Dynasty, we operate one of the most active investment banks in the RIA space. I think good chance we'll be head of the league tables for the second year in a row this year, given how active we are. We run a process. There'll be 40 or 50 potential suitors and buyers showing up for everyone.
Wow.
We've never seen more interest in this space. And the reason for that is it's a great business. It's a growing business. More and more people need financial advisors. It's annuitized revenue. You've got long-term market appreciation on top of working with high-quality advisors are going to be able to add growth on top of the markets. It's a bull market for advice, and it's a bull market for advisors who own well-run businesses because the opportunity for them to monetize it has never been better in terms of options and candidly multiples that people are paying right now.
Bull market for advice. It's interesting to say this year in particular because it's a very complicated market and clients have very complicated needs. After 3 years of a bull market, we are now hitting a lot of choppiness. People need tax advice. People might want to sell businesses. They might want to sell assets. What are the types of things that people are trying to add to their businesses?
Yeah, I think complacency kills. It kills with investors, also kills with advisors. And sometimes when you have a little bit of displacement or shakeup in the market, it causes people to stick their head up and look around. So we actually, when we see markets moving significantly, our business picks up because more and more clients, some of whom are prospects for our advisors, now want to talk to an advisor. Right. So advisors that are being proactive and servicing and calling their clients will keep their clients. But if they're proactive calling other clients, they'll gain those as well. Similarly with advisors, whether they're breakaway advisors, let's say the market pulls back. Somebody might have been complacent with the amount of income they were making, but now they're making less. A way that they could make more again is to transition to the independent space where they can keep a larger percentage of what it is that they're earning. I do think specific to the question around M&A, buyers are becoming slightly more discerning. You're seeing a little more structure being introduced into the conversation. And I think if we were to get into a sustained market pullback, those things will accelerate. And the firms that are the most well-run, have the most modern technology, have great succession plan, can prove that they can grow in good and bad markets with inorganic or organic growth, that have a defined brand. It's not just the founder's name on the door, right? But it's sustained over a long period of time. Those businesses will win disproportionately to some of their peers who haven't made those investments if markets continue to pull back.
Well, I was just going to ask you that. You said 40 to 50 potential buyers coming into any given deal. How many of those buyers look at the price tags of an acquisition or a stake acquisition and say, it's too expensive?
Yeah.
We want valuations to correct.
I think there are some that are being very patient. There are some that are not, and they're continuing to push the multiples up. We did a transaction recently above a 20 for an RIA, 20 times, actually almost 21 times EBITDA. We did quite a number at the 19 to 20 range last year. And if you look at, over the last 5 or 6 years, you've seen a slow creep of about half a turn to a turn a year. Do I think that we're going to see an environment where you're getting 25 times? I don't. I think we're close to where the market is topped off. But there's still there's some wiggle room on structure, and the old adage, right, Sonali, which is you tell me the price you want, and I'll tell you the terms and the structure. So we are seeing some advisors that want to hold on to getting that 20 multiple, but maybe are being a little bit, I want to say naive, or maybe complacent again in the negotiation, where they don't necessarily have the right advisors around them, and they're signing up for things that might bite them down the road because they don't understand the vernacular as well.
Yeah, how many people are looking at you and saying, well, I've run my practice for so many years, I'm looking to sell a stake. Actually, based on what you're saying, that's kind of a difficult spot to be in because if you're a buyer, you want to have continuity.
You want to have continuity, and whether you're a buyer or seller, candidly, you want to start early, right? And really understand, when's the right time to go through that process. The best time to sell a business is when you don't have to. Right. So if you're in a situation where it's distressed, you have old technology, you're losing clients, you're losing employees, that's not a good time to become in a market. Right. But if you have a really well-run business and you want to go out and test the market, which we do sometimes with clients, you might find that it's a really good time. You might find that it's not. And you say, OK, I'm going to wait, go back in, focus on running my business, grow it for a couple more years. Then I'll come back out and test it again. We see that from time to time. But again, the best thing that you can do is build a great business, run a great business, get educated, talk to your peers, talk to those that have made mistakes, those who have done it well, learn from them, get covered by investment bankers that can give you market commentary and intelligence, learn the vernacular. It's a little bit like, if you were going to go out on the battlefield against our Navy SEALs, would you want to learn to shoot the gun when you're out there? Or would you want to be well-trained in advance? And if you're facing off against investment bankers and private equity firms that do this for a living, and you haven't put the work in advance to get educated, you shouldn't be surprised if the outcome is one that maybe isn't exactly what you wanted at the end of the day.
It's a lot of expectation setting. One of the things you said was old technology. And I think whether you're in wealth or any other industry, you're really thinking about what AI is going to do to you right now. Right. And that's particularly true for wealth, right? You remember new technology sent a lot of the biggest companies in the public markets down, 10% on a single day because people were so afraid about what AI would do to those existing businesses. Now, of course, AI is not going to take these businesses away. In fact, it might make them more efficient at the end. But I'm sure that this is in the minds of everyone who's running a wealth business today.
Well, if it isn't, it should be, right? And I think we're headed towards a period of time where we're seeing some rapid, what I'll call cyborging of the industry, which is advisors taking the best of what they do, which is providing advice with human empathy, proximity, understanding of key life events, whether you're having a child or selling a business or, God forbid, losing a loved one or going through a divorce, whatever it might be. You need, I feel, to have a human being that you can sit across the table from and who understands, a lot of the emotions that you're going through. But then the implementation, once you've made the decisions on what the strategy will look like, lots of the implementation can be done by bots, right, or by AI. In the firms that do a really good job of investing in their people so that they can give better service, better advice, with leveraging modern technology from an implementation standpoint, they're going to be not only the most valuable, but they're going to be the ones that flourish and grow the fastest going forward.
So cyborgs, AI bots, it's funny when you think about what's possible with AI in a wealth management firm, what is this going to mean for the future? You think about the ones that implement AI and already have that efficiency to them. I'm sure that it must translate into better premiums.
It definitely should, because the result is they're going to grow fast. They're going to be more efficient. They're going to have higher margins. Therefore, they'll have higher value. At Dynasty, we talk about, part of our tech strategy is bots over bodies, right? So, we're going to have hundreds of digital employees on a go-forward basis. We have a whole AI labs team that's developing quite a number of bots, including AI Shirl, which is a little bit scary.
What's he like?
It's too much like me. That's why it's even has all my bad dad jokes and everything, which it's fun to be in the lab with the engineers and see what they're building there. But it's being done so that we can drive further scale and efficiencies in the business. I think you're going to continue to see margin pressure in our industry, even though it's a bull market for advice, and advice is more needed now than ever. There's still going to be more competitive pressure, more margin pressure. And if you can tech enable the business, so if you have 100 clients today, that you can cover 200 clients tomorrow without having to double your staff, because you're leveraging technology and being able to differentiate service and put scale in the business, then you're going to build a very valuable enterprise over time.
Okay, so AI bots, you're saying hundreds of digital employees, even of yourself.
Yeah.
So what does that mean in terms of how, frankly, it makes other people feel? If you're an existing employee, how do you feel working alongside an AI employee?
Well, I think it's inevitable in terms of the psyche of most people are self-protective, and they worry about what is it going to mean? Am I going to get dislocated or have my job replaced? At Dynasty, what we focus on is just retraining. And we're not looking to have less people in terms of letting people go. We're looking to be able to grow more efficiently so we don't have to hire as many, because we're leveraging technology. We're still in the very early innings, and we've been, here obviously at this great, iCapital Connect event, and there's been a lot of conversation, which really centers around slowing down the hiring, not stopping or pulling back. And I think for the foreseeable future, that's probably where we are. How disruptive it can be down the road. I think if someone's going to sit here and definitively tell you what it's going to look like, obviously none of us know. But I really think that for the foreseeable future, wealth management advice is going to be delivered by human, and technology is going to help support, enable, drive forward that human advisor to serve more people. I just don't think it's going to replace them.
It's interesting because at the same time, you do need a human, given how much AI slop there is out there.
Yeah.
Too, there's a lot of junk that's
Yes.
created by AI. What do clients think about it?
I think, depending on the age of the client, some older clients certainly are annoyed by it. They recognize AI slop, especially, imagine, I say to advisors all the time, you've been communicating with a client for 20 years. They know how you communicate. Then all of a sudden, your communicating style has dramatically changed. They know it's not you. So what we're investing in, bots that help drive communication for our advisors in their own voice. So it's inside of our desktop. You can say, write a note recapping the last year with all my meetings, with Susie Jones, but do it in my voice. And it's analyzed a lot of the advisors' emails, communication style, so it can drive scale without losing the personalization of it. And look, there are some advisors and some clients that, they're never going to get there. And that's okay. Unless, of course, the speed of acceleration is such that it forces them to either have to catch up or hire employees that'll help them catch up. I think it's going to be fascinating to see over the next 4 or 5 years. For us, we have to be on the forefront. We're a wealth tech business. We doubled our AI budget this year, actually more than doubled it. We're big believers. We're pro AI as enabler to advisors and our employees, not in replace of them. And we're betting significantly on the cyborging of our industry.
But to your point, there's a generation that wanted to be on the phone with you.
Yeah.
But there's a generation that rather talk to a Claude or an OpenAI or, they'd rather be on the internet. And, I do find that in my travels, there are a lot of wealth advisors that are struggling with a generational change.
Yeah.
How much do you find that?
Well, we've been running all types of different tests, and it's interesting. So we're creating bots that provide scaled communication on the markets. So imagine if you're an advisor or a big advisory firm, you have thousands of clients and the market, is particularly volatile in any given week. Historically, advisors are on the phone, at the end of the week, nonstop. They're trying to push out communication, email to the clients. We're creating bots now that sit on top of our data lake and can push communication at 4:15, 4:30, whether it's to the phone or email, that provides a recap on what happened in the market. What's really fascinating as we've played around with it, if we take that bot and convert it to an avatar so that it looks as real as you and I, and push out the avatar, the engagement is multiple times higher. So even though someone knows that it's AI, the fact that it resembles a human is driving significantly higher engagement. I think there's some interesting learning in there.
So before I let you go, I want to pivot a little bit. We were talking about a lot of trends in the industry, M&A, stake sales, AI adoption, what this means for talent and recruitment. One of the big themes in recruitment is how many firms have seen exoduses of teams. And for you in particular, Dynasty partnered with a team called OpenArc that you have called a watershed moment for them. Why is this a watershed?
Well, it's a watershed moment because it's the biggest team ever to move in the industry, let alone the biggest team ever to go independent. They moved 135 team members, significant pool of assets. They were a stock plan team, so they were covering stock plan administration for some of the largest companies in the world. I started Dynasty 16 years ago. In the early days, the big box that was left to uncheck was corporate services. And I've been working on this thing for a decade to find the right team to come into the space so that we could check the final box to say there's now nothing that can't be done as well or better in the independent space. So now we have one of the largest teams in the entire industry go independent, providing corporate services, providing independent fiduciary-based advice to the executives of those companies, growing really fast. And why I think it's a watershed moment is because now other multi-billion-dollar wirehouse teams or teams that are in captivity who might have sat back and said, I just can't envision my business. It's so big, it's so complex, being able to go independent. They can look out and see one of their peers that, because it's the biggest team in the industry, obviously, is as big or bigger. And they did it with that level of complexity. And we're already seeing it. We're going to be launching more deals later this year. Large teams that were inspired by that move and other recent moves that we've done. We've now launched over 25 firms, de novo, breakaway, set them up, that have enterprise value over 100 million, right? So the wealth creation that's happening on this side, it's undeniable. It used to be a trend. Now it's a strong movement, and advisors and clients oftentimes like to follow what their peers are doing. And since the road to independence is now so well traveled, I think you're going to see more and more bigger teams start to go down that path.
So the final countdown playing in my head.
Yeah. Well, it's not for everyone. And I think the wirehouses aren't going anywhere. But more and more consumers, clients want advice separate from where products are manufactured and sold. And if you look at, some of the biggest movements in our industry, it's client-led, and clients are saying, I want fiduciary-based advice separate from where products are manufactured and sold, from an advisor who has scale and can shop the whole street. I mean, once you understand it that way, and I sit with hundreds of clients a year with our advisors, inevitably they say, why wouldn't everyone want that? And I think they will, and that's going to continue to drive the acceleration of the independent movement, because it'll be as much breakaway clients as it is breakaway advisors.
Well, I'm looking forward to seeing where all this is going. I'm also thinking that maybe the next time we do this, it is the Sonali and Shirl avatars
Oh, yeah.
speaking.
There you go.
But, you
Yeah.
know, let's see how fast we can get there. Shirl, thank you so much. That is Shirl Penney. He is the CEO and founder of Dynasty. You've been watching Beyond 6040.